Hi everyone. Welcome to this first episode of the new show, Decode with Shyam Sekhar. A very important topic for the first show. We all are seeing the world order changing beginning the 1st of March. So macros, the global macros are getting reset. So a bit of discussion on this topic and ultimately what it leads to for the investor. So hi Shyam.
Hi.
Hi. So this is a very important topic for an investor today. See, if things had continued as it were, status quo on January 1st, or even when the budget was passed on February 1st, when the budget was presented on February 1st, things were very different, would have been very different. But today, everybody is all looking up to what the US and Iran are doing. So what has changed in this space?
See, I think the assumptions in the macro of every country has changed dramatically. And it's very simple as to why it has changed. We were all positioned for $65 oil. Suddenly when you change this to $100+ oil, then what happens is that your trade equation changes, your exchange rate changes, your inflation changes, your interest rate as a consequence may need to change. A lot of industries which have assumed a certain level of growth based on $65 oil suddenly find it unviable to operate at $100 oil. It's higher than 100. I'm just saying 100 for ease of a number. And people are talking about oil going further into a higher zone because of supply disruptions. Petrochemical, which is such an important element in our consumption, is in a territory which is scaring industries based on petrochemicals. Aluminium has seen supply disruption because of what happened in Qatar. So multiple industries are seeing disruptions, right? And when they are seeing disruptions, and when you see that there is a threat of further disruption, then this macro reset suddenly looks bigger than what we thought it would be.
True.
Everyone was thinking the war will be over in a month. It probably will in a few weeks. But even if this war ends in a few weeks, it is not so simple because I don't expect certain markets to cool as fast as we thought it would. And I don't expect supply disruptions to be restored at the speed at which we would like it to be. Gas is a classic example. So supply disruption is not going to be restored so fast. So somebody else has to come in and supply. So in this environment, the macro of every country is going to change. India's macro particularly suddenly looks vulnerable. And we have seen how things change when our macro moves from secure and very predictable to vulnerable, right? So most people, I believe, investors, have forgotten what it means to be invested in an economy with vulnerable macros. Because post-COVID, COVID created the extreme vulnerability. So once you came out of that extreme vulnerability, you thought that we will have no more of it, right? So 4 or 5 years, it just went one way up. People forgot the past, or they are too new to this, one of the two things. So I think that this year, what has happened is a throwback to the classic phases of the past, like 2012 and many more before that, where the economy suddenly is forced into a state of vulnerability. So first we have to overcome that. And only after that, we will see growth. Whereas on Jan 1 and Feb 1, we were moving towards growth. Our growth projections were 7.4 or whatever, for the next year, which means that we could have actually done better than that in the subsequent phases. Now, we are first going to see a contraction, the extent of which is still open. It depends upon how this war turns in the next few weeks. And even if the war ends, there will be a contraction. And subsequent to that contraction, we have to see how we are going to go back to growth. First, we have to go back to that 7.4, right? So the stock market, I think, is mentally still not ready for this. That is the feeling that I'm getting. Either you have people who are extremely pessimistic, who are saying that even this valuation of Nifty is high, or there are people who kind of gloss over the whole thing and say that no, nothing will happen. Once the war is over, the market will again bounce back. Whereas the truth is somewhere in between. That's how I view it. And I think we have to reset our expectations in our investments. We have to reset our timelines in our investments. So your return expectation has to be reset, the timeline has to be reset, and we could have one more era where investing can be a slow grind and returns could be backloaded. So that is what I think we are heading towards right now. But I'm not sure people are ready for it. What do you think? You're meeting so many investors, you're writing, you've been doing so many things. Are people mentally ready to either lower their return expectation, accept no returns for a couple of years, and then a phase of rising returns? What is the state of mind that you are seeing? Are people really adjusting themselves to the world?
Okay, so there are two kinds of investors that I am seeing today. One set of investors are probably in denial mode because in the past there has been a liquidity rush and the markets have gone up very high. We don't know if this will happen very soon, but there is a set of investors who do expect that even we have even survived the COVID crash, so we will probably survive this maybe a few months, and then we will go back to the high return era of the past.
Expect V-shaped
of the past. So that is one set of people, and there is another set of people who keep talking to us about this is like every year this is happening. Every few years this is happening. So how can we invest in equities and sleep peacefully? And they go to the other extreme of saying, so we can't actually invest. So this is too dangerous for us. And they go into maybe an extreme asset allocation where they want to avoid equities at large. So I would say that, the way people are looking at it is not very rational. Both these extremes, it doesn't take you to a good, it doesn't take you, if you look at a portfolio, if you follow these two kind of extreme views, then you won't be able to navigate all this and, have a winning strategy for your portfolio.
See, I'll just talk about both these sets of people since you mentioned it. Let's start with the first set who thinks there'll be a V-shaped recovery. It's all very easy. All dips should get bought. Basically, they are post-COVID investors. They have never seen 3-4 years of flat markets. And they think that that will never happen again. And I think they have been so influenced, or rather influenced, that by listening to, somebody saying that all is well, things will go up tomorrow, the daily commentary of influencers, they think that whatever these guys said in the post-COVID recovery came correctly. So it will happen the same way in the future also. Whereas we are now in a market that listens to nobody actually, right? That's the truth. And you can be the best of investors, making the best of decisions, but still you will see the market go down after you buy a particular stock in that stock. Because the market is in a phase where there are enough irrational players. Okay, and these guys actually belong to the second category, right? So they are the guys who have come in thinking that every year they should make money in equity. That's the first problem. And second problem is, if you don't make return for 1 or 2 years, they would not give any more opportunity for that equity product or manager. So they'll just take out, or the category. And then they'll go and try somewhere else. So this impatient investing that we are seeing in the second category is moving capital out of products and moving capital around products. Both are happening. First, money comes out of some product, then it goes to something else, stays there for some time, then goes out. So you're seeing a kind of, like passing the hat.
Moving around.
Yeah, capital moving around. Now, what this capital moving around is doing is, it is creating very high impact cost. When they sell, that portfolio goes down. The residual investors or remaining shareholders are affected. And this is happening in product after product, in category after category, it's going to happen. So this is what is basically causing so much of further anxiety in the minds of investors. So not too many people sold and got out in COVID. You must remember that. Right? But now, I think enough people are going to sell and get out of very low liquidity products and create phenomenal impact cost for the remaining shareholders.
Okay.
I think that market is not ready for that. And I think this is probably going to hurt sentiment far more than even the war. War, yes, but when the war ends, there's a chance that you will heave a sigh of relief. But then the money moving around like this in low liquidity products is a big risk, according to me. And the FIAs are doing the same thing, the high liquidity shares, which is the index shares. You saw the trading volume in HDFC in the month of March, and how much FIAs are sold in the total sale.
Yes.
So this is probably happening in ITC also, in my opinion. It's happening in many shares. It's just that the media and the market observers highlighted the data in one company. So wherever FIAs are selling, you are seeing a valuation contraction, which is sharp, right? And I don't think that the bounce will be as natural, because you need somebody to come and buy aggressively and bid the prices up. So this downward bidding of the market, okay, which we saw in March, is probably set to continue for some more time. But it will move from one segment of the market to another, one category to another, one theme to another. We're going to see this happen for some time. Even if the war ends, this is going to continue. Because I think that people are losing patience because they have not made return on a 1 year or a 2 year basis.
Yeah.
A lot of people. And a lot of them are on their own. They're not, with any manager. They're probably influenced and on their own. It's not DIY which is the problem. It is FIY. Influence it yourself. That's what is the category. So some influencer is influencing an investor to act in a particular way, right? The investor is not acting on his own mind. Okay. So such capital is basically going to become more impatient, is what I think.
Okay. Now, Shyam, this question I had in my mind. Now, we started out by saying that the macros have become very different from what we saw in the beginning of the year. Now, for those people who are coming up and bidding at these prices, as you are saying, now, what are they taking the reset into consideration is my question. Are people going only by, what is beaten down, I'm going to beat it up, that kind of a mindset? Or are they investing for the next few years in this kind of a situation? Because opportunities for the next few years are being thrown up now. Are we looking at the macros and connecting it down to corporate earnings? Are investors doing it?
I'm not sure we are. Honestly, I'm not sure we are, because everybody is going and buying the same stocks which they already owned as they get beaten down. Or they are buying market favorites as they get beaten down. You saw how the IT stocks got bought during the first wave of correction by retail, by institution, by everybody. So then one more fall, number of people bought it again. Okay. Now, after they have all bought it, the shares have almost, kind of settled down flat. We'll have to see how they respond to the results. But broadly, what I'm seeing is that people are rushing, buying, and then going cold, right? So I think that people are not thinking whether what they buy will be benefiting from the macro reset. I'm not seeing that. It's just habitual buying, mechanical buying, if I may say so. But that's how this market is, which is quite usual, because if you take any boom in a particular space, you take the 2090 boom or the 2008 infra and capex boom. People continuously average downward for 1 or 2 years, even after the boom was over. After the boom had gone bust, people bought the same shares. And they gave up only after 3-4 years, right? So that is happening now in small and mid cap, right? Which is the danger today. So I think that this is a problem for which there are no easy solutions. You have to go through that pain. If you're doing this blind, mechanical buying and averaging of businesses which you bought before this macro reset, then you're going to have trouble. I'll give you an example. There's an army of people who bought ITCs earlier. We own ITC. But post this tax reset, which happened just before the budget in January, the economics of the business has changed. And post
this phase, probably growth is also going to change. So then you cannot assume that a fallen ITC will rise very fast. Unless the business is able to support it through numbers, you're not going to have a recoiling bounce, right? The same thing applies to most of the IT companies, right? Today, it's probably applicable even to HDFC Bank. It's not a mechanical bounce. The company has to follow through with growth which the market likes. It has to follow through with performance which beats the market's expectations. And it has to guide or kind of hint that its trajectory is going to change for the better, right? So many things have to happen. But the market is just mechanically buying these stocks. So this is happening across. It's happening in the small and mid cap. It's happening in the headline company.
But that is also true of all cycles, isn't it? People don't choose the next winners. They always chase the past winners. So that becomes a...
In my view, that's the biggest risk of this macro reset. This war has basically exposed us to more of that risk, unfortunately, because we have not factored in what can happen.
Because it is not easy to factor in.
No, but essentially, when we, for any investor, when we talk from a macro perspective, now how the trickle-down effect happens, for example, the whole thing is about oil not being available and India being a big importer of oil.
Gas
and gas also. So now how the trickle-down effect happens across sectors and across segments, is an investor able to decipher is one question that we have. Are people actually looking only at company fundamentals and going into investing, or are they applying the macro to the sector or to the stock?
I have a feeling a lot of investors are only looking at price. They are not even looking at the fundamentals.
Okay.
And when you are not looking at the fundamentals, you're only looking at the price. Your investment decisions are not aligned to what is the value of the company. So it's just mechanical averaging. That's what is happening.
Okay.
So that's what most people are doing. And they're doing it in companies where the reset is going to change many things quite sharply. For example, let's say a company buys petrochemicals and makes a product which it has to export to many of the countries affected by this war. Then you are not assuming how the disruption will happen. You're not assessing the extent of the impact. Similarly, let's say that domestic consumption is something you're trying to take into effect. First, we have to know how much the fuel prices will go up, how the government is going to pass on the price hike to the customers. We don't know that. So people assume there won't be a price hike, right? Whereas you have to assume. And then you have to see how it will hit the wallet of the consumer. And then you have to see how consumers will respond. There's so much to be done. But people are just blindly mechanically averaging without understanding each business, each industry, whether the industry is better positioned to withstand this inflation shock.
True.
Or demand shock.
No, but that I think is true of all investors in most cycles, because people think that, when the tide rises, it will lift all the boats.
That is true. But you are assuming the tide will automatically rise.
One thing. And the other thing is also the fact that people don't actually consider that they may see different winners and all that. So that
is the case. See, today if you see, I think in this calendar year itself, in the index, maybe in the last 3-4 months, one of the best performing companies is Hindalco. We have not even noticed.
No, I haven't.
Yeah. That's how it happens.
Yes.
You know that HDFC is not performing because it's very visible in your face. But nobody is interested in talking about a company like Hindalco or maybe even Vedanta has run up quite a bit in the last 3-4 months. So these companies which we thought will be out of favor actually have done very well, right? SBI is another dark horse which has done very well. Slowly you are seeing that sentiment is turning on companies within the Nifty which we thought were not very interesting, right? Whereas the more exciting, interesting companies are all derating continuously. So I think why is this happening? Because most people are only looking at the price of companies and they are not going and buying the right companies.
Yeah.
Right? How many people would have bought the companies that I mentioned, which have gone up? Very few, right?
True.
Very few people would have bought these companies. Only the contrarians would have bought, practically. And how many contrarians are there in the market? So this is a market where if you're aligned to valuation very sharply and you're looking very closely at the market reset, then you veer towards contrarian investing. This is a classic market for contrarian investing. Because as you said, nobody is looking beyond the recent favorites. Right? But you have to move beyond the recent favorites and look at what will be the favorites going forward into the future, maybe 1-2 years down the line. That's where there's a lot of money to be made. But I'm not sure this market is ready. If you ask me, more than the macro reset, which I think economy will withstand, I think this mindset reset which investors have to make is a bigger issue. It's a bigger problem for which there are no easy solutions, because in every market cycle, people have spent 2-3 years buying the same stocks from the previous bull run. Then either they lost money or they didn't make any money, but the rest of the market may actually move away from them. And then they realize that they are missing out on something. Finally, they'll sell and buy whatever is the market favorite out of FOMO, and those stocks will again pick up further momentum. So this is the cycle that we are heading towards now also. I'm not seeing much contrary investing happening around us. And that's the clear area where I think this market reset needs to be focused upon. I think we need to change our thinking because a lot of things are going to change.
So it's interesting to hear, that investor mindset always remains the same and it is yet to change. But from the other side, if you see an institutional investor or a manager, so, these people tend to respond to these changes faster. They are expected to because they are in that profession. So as a manager, how are you managing your investors' money today? Where are you taking the calls?
So, it's very important to keep preparing our investors. That is one thing that we need to do. So, we need to communicate very closely with the investor. We need to address all their concerns and queries. And we need to mentally prepare them for a reset in their portfolio, not just the macro reset. And in the WhatsApp era, it's very easy for investors to conclude wrongly. Sometimes we have to fight those wrong conclusions first. And it is very difficult to keep the investor focused on what he needs to do in his portfolio. Investor will be willing to debate with you on what is happening in Iran and this and that, and what they think about, let's say, what is happening in Saudi Arabia, or what will be the stance of Oman or Pakistan or India, and all sorts of things. And the politics aligned to all this. But when you start saying that, hey, listen, that's all there. But today, in your portfolio, you need to put 5% into this place. You need to put 5% into that place. I find that the number of investors who are willing to actually apply themselves to the situation to do what is right for their portfolio is not a big number. And the task of making them do that is quite a responsibility. As an investor, I have never had so much trouble convincing myself to do the very same things in any past cycle. It came naturally. But when I have to convince a third person, it's quite a task. But we keep doing it because we are signed up for it. We keep on doing it. In the process, some people will not align with us. It's sad. But then we need to move on and work for the people who are aligned with us. So, in a sense, one tends to become more detached and philosophical in the job of convincing others to do what is right for them. If they agree and do all the right things, it makes you happy. If they don't agree or they disagree vehemently and fail to do what is right for them, we can feel sad, but we need to still move on, because the onus of doing what is right for oneself in his portfolio in times like the present, where you are having a macro reset, is squarely on the investor. And this is something that I have learned from the past cycle. So when I am not the investor and I am actually handholding an investor and guiding him, while I can do my best, there is only that much that I can do. But the important thing is to give your best before the investor decides which is the path for him. And that's where I think that this macro reset has been a very interesting opportunity, because we are talking to the highest number of investors professionally in our ecosystem. And we are seeing a good section of them respond correctly. We are seeing a small section struggle to cope. And we're trying to help them to the best of our abilities. But sometimes there are some situations where people don't want to be helped. At that time, we need to kind of accept it. And that acceptance is also part of my evolution from an investor to a manager. So that's the important takeaway from this macro reset.
Okay, that was a very interesting conversation. We will meet in the future weeks for more such Decode conversations with Shyam Sekhar. Thank you very much for listening in. Stay tuned and see you around.